Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. In this episode, I'm going to share with you 401 words written by Warren Buffett that have more wisdom per word, investing wisdom per word, than anything I've probably ever read. There's two reasons I'm making this the focus of the episode. First and foremost, the investing wisdom is time-tested, it's usable, and that's really what our podcast is all about. The second reason is, well, it's because it's a reminder. It's a reminder like the reminder that I started episode 8 with, and that is a reminder to all of us to read these letters and read them often. And by the way, you can read all of them for free at berkshirehathaway.com. Now, a few years ago, I was in a used bookstore. I'm not sure why. I think I was walking somewhere and saw this bookstore and I said, ooh, books. Inside, I saw they were selling a book that compiles all the Berkshire Hathaway annual shareholder letters. I think I bought it for $3 or something like that, but I'm glad I did, and I've been reading more physical books over the last few years because of this reason. When you have a physical book, it's a tangible object that can be a trigger. So the other day, this book was just calling my name. So I decided to flip open to a random page. And what I read after flipping it open is what I'm about to read to you now. Once I'm done reading this, I'll tell you what year it's from and provide you with my key takeaways and insights. With all that said, let's get to it. Warren Buffett writes the following: intelligent investing is not complex, though that is far from saying that it is easy. What an investor needs is the ability to correctly evaluate selected businesses. Note the word selected. You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. To invest successfully, you need not understand beta, efficient markets, modern portfolio theory, option pricing, or emerging markets. You may, in fact, be better off knowing nothing of these. That, of course, is not the prevailing view at most business schools, whose finance curriculum tends to be dominated by such subjects. In our view, though, investment students need only two well-taught courses: how to value a business and how to think about market prices. Your goal as an investor should simply be to purchase, at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will find only a few companies that meet these standards. So when you see one that qualifies, you should buy a meaningful amount of stock. You must also resist the temptation to stray from our guidelines. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value. Though it's seldom recognized, this is the exact approach that has produced gains for Berkshire shareholders. Our look-through earnings have grown at a good clip over the years, and our stock price has risen correspondingly. Had those gains in earnings not materialized, there would have been little increase in Berkshire's value. The greatly enlarged earnings base we now enjoy will inevitably cause our future gains to lag those of the past. We will continue, however, to push in the directions we always have. We will try to build earnings by running our present businesses well, a job made easy because of the extraordinary talents of our operating managers, and by purchasing other businesses, in whole or in part, that are not likely to be roiled by change and that possess important competitive advantages. End quote. Those 401 words come from Warren Buffett's 1996 annual letter. Now, rather than regurgitate Warren Buffett's key points, I want to show you something that's hiding in plain sight. What Buffett is describing in those 401 words is an exercise in probability, one that improves your chances of picking a stock that will outperform the market over a long time period. Investors like Warren Buffett, the best investors, they think in terms of probabilities. I came to this realization while reading the Warren Buffett portfolio, and the following comes directly from that book. Quote, "It is a vast oversimplification, but not an overstatement, to say that the stock market is an uncertain universe. In this universe are hundreds, even thousands of single forces that combine to set prices, all of which are constantly in motion, any one of which can have a drastic impact, and none of which is predictable to an absolute certainty. The task for investors, then, is to narrow the field, to identify and remove that which is the most unknown, and to focus on the least unknown, and that is an exercise in probability." End quote. If you buy a low-cost index fund, what is the probability that the 10-year annualized return that you achieve will be the same as the market rate of return? Well, unless we're getting really technical, the answer is 100%. But if you buy a single stock, what is the probability that the annualized return will be better than the market rate of return? There are several thousand companies that trade on the New York Stock Exchange and NASDAQ. Looking at the past 10 years, a small percentage of these companies outperformed the 10-year annualized returns of the overall market. For the purpose of this podcast, let's say it's 1 in 10. So 1 in 10 stocks will do better than the average market rate of return over a 10-year time period. So based on these prior probabilities, our odds of picking companies that will outperform the stock market are 1 in 10. Those 401 words from Warren Buffett offer an excellent approach to narrowing the field. You start with that group of several thousand companies, and you use this process of elimination. Let's recap. Eliminate any businesses that are outside of your circle of competence. Eliminate any businesses that are not easy to understand. Eliminate any businesses that are unlikely to be impacted by change. Eliminate any businesses that do not have competitive advantages. Eliminate any businesses that do not have able and trustworthy management. Eliminate any businesses that don't have a positive historical track record. And finally, eliminate any businesses that are not rationally priced. It's all a process of elimination. These filters that Buffett describes remind me of a test-taking strategy that I learned in middle school. Let's imagine we're taking a standardized test and there's a multiple choice question with 5 potential answers. Only one of the answers is correct. The problem is, we have no clue what the correct answer is. If we randomly select an answer, the odds of selecting the correct answer are 20%, or 1 in 5. But before we do this, let's eliminate any answers that we know are incorrect. So let's say there are 2 answers that are just glaringly wrong. Cross them off. They are no longer options for your final answer. And by doing this, we've narrowed the field. Now, if we select an answer at random, our odds of being right are 33%, or 1 in 3. This strategy greatly increases the likelihood that we will select the correct answer. Now, remember what Warren Buffett said our goal is. Our goal as investors should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Now, that's a difficult task for any investor, but in order to give yourself the best chance of long-term success, you have to eliminate anything that would almost guarantee failure. So a business you don't understand or that doesn't have a moat, or maybe they have management that you don't really trust, well, just eliminate those from the possibilities. In just a moment, we'll hear from Connor, the overconfident investor. He's going to offer a rebuttal to what Warren Buffett is talking about or was talking about in those 401 words, but we'll get to that in just a moment. But first, there's a few items I need to cover before we close out this episode. First things first, if you have any topics you'd like to hear us cover in an episode, send an email to franco@cmqinvesting.com. franco@cmqinvesting.com. To learn more about probability theory and how it relates to investing, subscribe to our free newsletter at cmqinvesting.substack.com. Last but not least, if you are listening on Apple Podcasts, we would greatly appreciate if you take a few minutes to leave a written review. We love reading them, and they go a long way in helping other people discover compound money quietly. It's me, Connor, the overconfident investor.
I'm gonna live forever.
What if I told you that I could double your net worth by next Thursday?
I'm a genius.
And guess what? The probabilities? 100%. Okay? And by the way, next time I want to hear a 401 word bedtime story, I'll go to the kids section of Barnes & Noble. Enough of that folksy nonsense. We ride Lambos around here, baby. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.